Hi everyone! Today we're diving into moving averages, what they are, the different types, and how to use them. So what's a moving average? It's like connecting the dots of daily average prices over a specific period to form a line that smooths out the noise. For example, take the past 5 days' prices, average them, and connect those averages. That gives you the 5-day moving average. Same goes for the 10-day, 20-day, or even 60-day lines. Moving averages help iron out the wrinkles in price action, making trends easier to spot. While prices might jump around like a caffeinated squirrel, the moving average keeps it cool and steady. That's why moving averages are go-to tools for spotting trends. When a moving average starts to bend, it's often the first whisper of a trend reversal. Now let's talk types. There are two main ways to calculate them: simple, average, and weighted average. We'll stick to the simple method for now. By time frame, we've got short-term, mid-term, and long-term. Short-term, think 8-day or 12-day. Those two are my bread and butter for swing trades, as long as the stock stays above the 88 line. The short-term trend is solid, but regular stocks might dip above and below too often, causing a bunch of false alarms. That's when the 12th day MA comes in handy. If you're a swing trader, don't sleep on the 12th day. If the price stays above it, that's still strong. Midterm MA include the 20, 30, 45, and 60-day lines. The 20 days are fan favorites since a month has about 20 trading days. It reflects the average cost for the past month. I use it a lot. When the price breaks above the 20-day line and that line starts turning up, that's a green light for a strong trend shift. The 30-day, some big players treat it like a guardrail. The 45-day is kind of rare. The 60-day, though, is a classic. It's the go-to for midterm trends. If the 20-day is too twitchy, the 60-day smooths out the chatter. Now for the long haul. 120-day and 240-day lines are your long-term crew. The 120-day MA is also called the half-year line. The 240-day, that's your year line, your bull-bear dividing line. If a stock climbs above the year line, bulls might be back in town. Drop below, and it could mean bears are taking over. So which ones should you use? That depends on your style. If you hold for just a few days, stick with the 8-day and 12-day. If you're in for a month or a quarter, go with the 20-day and 60-day. And if you're in it for the long game, say a year or more, then the 60, 120, and 240-day MA are your best friends. Now let's talk strategy. First up, the golden cross and death cross. These are classic starter moves. When a short-term MA crosses above a long-term one, we call it a golden cross. When it crosses below, that's a death cross. Simple and sweet, but not foolproof. In choppy markets, they can cry wolf too often. That's why you don't want to go all in on just one tool if there's too much noise. Step back and look at longer MAs for clearer signals. Next, bullish and bearish MA alignments. When a few MAs are moving together in the same direction, either all rising or all falling. We call that a bullish or bearish alignment. These often show up in strong trends. Bullish alignment, the rally's likely got legs. Bearish alignment, the slide's not over yet. Wait for lines to flatten or cross before jumping in the opposite way. Third, convergence and divergence. When MAs come together or fan out, that's telling you something. We call it sticking together when MAs are tightly packed. This usually happens when the stock's been going sideways for a while. Everyone's sitting on similar cost bases. Not much action, just waiting for a breakout. Then comes divergence when MAs start spreading out. That's a sign the stock just broke out of a nap and is ready to run. The longer the MAs stick together, the more explosive the move could be when they break apart. Alright, now let's hit Granville's 8 rules up. Classic playbook for reading the dance between price and MA. 4 buy rules, 4 sell rules. First, by signal, the MA flattens out and starts turning up. Price crosses above from below. Boom, golden cross. That's your early bird special. Second, after a sharp move up, price dips toward the MA. Looks like a breakdown, but it's just a fake out. That's your bounce back chance. Third, the stock pulls back naturally and hits the MA right, where most people bought in. Nobody wants to sell at break even, and buyers step up. If the MA holds as support, that's your green light. Fourth, price has been in a downtrend hanging out below the MA. It gets oversold and snaps back, just a quick bounce to test resistance. Not a full reversal, but worth a shot if you're nimble. Now the 4 sell signals. First, high-level death cross trends turning sour. Second, price fakes a breakout, then falls hard. That's your last chance to get out before the real drop. Third, price tries to climb but hits the MA like a ceiling, then tumbles. It's still in a downtrend. Don't fight it. For the price runs too far ahead of the MA. It's gotten overextended and might pull back. Time to trim the fat. Of all the sell signals, number 2 is usually the final exit ramp. Number 3 is a trap. Don't go buying in there. And number 4 only matters when the move is big and fast. Now, all of this Granville's rules, MA, crossovers, they're just tools. They're only as sharp as the hand that wields them. Some folks turn these tools into deadly weapons. Others just swing them around and hope for the best. This series is just the foundation to make it work in the real world. You need reps, tons of practice, and real trading experience. That's it for today. Catch you in the next one.